Knew that was there for a reason.
Welcome. Yay! Okay, we definitely got plenty of seats for you.
I'm learning all I can right now about that.
Digital was scary. Not scary. I just know so far away.
Welcome, ladies and gentlemen, to another wonderful lunch and learn session. Sure to be very informative and a great resource for you as a realtor, personally and professionally, correct?
Correct.
So we welcome here today Steve and Ann.
Hi.
Thank you.
You're welcome. That's it.
Well, thank you very much for showing up. And you know, this is actually just planting the seed. This is totally on the educational side, and it's got to do with, like you were saying, personal education as well as helping your clients out as well. And this is a unique part of now the investment industry, and it's fairly new. And typically when I take a survey of a room, not very many people have ever heard of private equity investing. Yes? Yeah, have we? Well, you know what's interesting is private equity investing is second mortgages. That's one of the aspects of private equity investing. But this is much, much more overseen by Ontario Securities Commission. All right, so without any further ado, let's get into what we're going to talk about today. So there's many different words for private capital markets. You'll hear private equity markets, exempt markets, alternative markets. This is away from the public markets. So everybody knows the stock markets, correct? Well, these alternatives have nothing to do with stock markets. They're all private. So you're buying companies, you're buying real estates, you're doing second mortgages, mezz financing as a way of investing your money. And that's what the exempt market is all about. So today we're going to talk about some traditional investment models. There's a shift in the industry, which I'm going to allude to, and how can you be proactive with your own investments, and then you can insert that as well as clients as well. So let's talk about long time ago. What's changed? Well, in the old days, and again, I'm going to use a personal example where when my father came from Poland 50 years ago, and he had a little bit of money with him, he came and he bought some land. And he used almost all of his money to buy this land, and he wanted to build a house. So he had to go to the bank and showed the bank the plans, showed the bank where the land is, the deed to the land, and said, but I need $7,000 now for the materials to build the house. And the bank looked at him and said, you look like a good man, Mr. Blasiak, shook his hand and cut him a check for $7,000. Has anybody ever had experience like that in this day and age? No, of course not. Why? Because the banks now are completely run like businesses, right? So you have to fit into that square box. You have to tick off all the check marks if you're ever going to get a loan or anything from the banks. Not like it was back 30, 40 years ago. So what do people do when they're looking to, back then, when they were looking to invest money? A lot of them just put their money in the savings accounts. And one of the main reasons is that in May 1990, in your savings account, you were earning 12.8%. So who needed to take a big chance? And I know, I wish my own portfolio could be 12.8%, and that's a savings account back then. So people didn't have to go too far to earn an excellent rate of return. Nowadays, I think a savings account, any idea, paying maybe under 1%, exactly. Yeah. And so that's
you can get one.
unless you're locking it into a 5-year GIC. 5 years, you make 1.2%. Yeah, yeah, exactly. And you're not getting ahead of life because inflation's running around 2%. Exactly. So this makes you work. This makes you get out there and think about, what should I do with my investments? What should I do with my savings? What does my future look like? How hard do I have to work? How much do I have to put away? But you know what? A lot of people put their money into the stock market through mutual funds. Actually, again, if I took a survey, that's probably where most people put their savings, is in the stock markets with their mutual funds. And a lot of people just trust their bank. They walk in, Say, Mr. Bank Manager, here's RSP money, set it up for me, and put it in one of your famous mutual funds. So the only reason that is getting less and less appealing today, as opposed to 15, 20, 30 years ago when mutual funds were first created, is that mutual funds are becoming far too volatile along with the market. As well, you add into the fees into mutual funds, and you've got a recipe for disaster. If you need to pull your money out at a certain point in time, then because of the volatility, you're like taking a gamble with your money. Now the government realized that that's not a very, very smart place to put money in if people are going to be needing it upon retirement, or if they're going to be buying a big ticket item. So where else can you put your money? Well, what we've done is we thought about, well, what do big, huge investment strategies like our Canada Pension Plan Investment Board, what do they do for investing money? Because places like Canada Pension Plan, Ontario Teachers Pension Plan, OMERS, which is Ontario Municipal Workers Pension Plan, all these people, all these organizations need to pay out millions and millions of dollars every month. So you can imagine if they had all the money in the stock market and the stock market, whoops, took a dive down, they'd be selling underwater, right? And you don't want to have that. So they've come up with an excellent, excellent plan that if you look closely and if you look at your portfolio, and if your portfolio mimics their portfolio and they're being successful, then you'll be successful in your investment portfolio as well. So what is it? First of all, let's see. They've got $316 billion of asset under management. In 2000 and I think it was 2017, yes. 2017, they did 18% return on that much money. Not bad. 5-year average, 11.8%. So other than the fact that they daily trade and they totally understand what their portfolio does every moment, every time, one of their secrets is the amount of exposure they have away from the public markets, away from the stock markets, and into what we call the private equity investing. So they buy real estate, yeah. They buy buildings, yeah. They buy bridges and toll roads. They have second mortgages. They do all this kind of stuff in the private equity sector. And you can see that the amount of that $300 billion is growing that is over in the private equity side. As a matter of fact, today, it's over half, don't be shy, over half of the fund, 52.3%, is in private equity, all right? What does that do? Well, listen, there's nothing absolutely wrong with the stock market as long as you know where you're investing, and that when a sector dies down, like i.e. the auto industry is dying in North America, you know not to have mutual funds or exposure to the auto industry. So you would then actively take your money out there and put it into something else. So that's what these guys do. But they also have more than half of their investments into the private equity because it's more predictable private equity. And it's more of an absolute return. If you look at somebody that buys a rental apartment building, you know that whoever, all those people that are in the rental apartment building are going to pay their rent every month, right? So that is a predictable return, and you know your expenses, which are set. So the predictable profit, you can forecast out how much money you're going to be making from that investment for that year, right?
And Steve, it also speaks to smart money, which is institutional money,
Yeah.
is recognizing the fact that the stock markets, the capital markets are fully valued.
Mm-hmm.
So they're taking some of their profit away from the stock market and going into private equity to get the more predictable, consistent returns.
Right.
Yeah.
And so we've had a history bear run, so a history run for the longest time that the stock market's ever been around, that it's been up. So they say what goes up sometimes is going to come down. So it's not only just the CPP, or there's a lot of different pension plans and endowments that use exactly this model where they've got, like Yale, 58% is private, 41% is public. So there's a lot of the big institutions, like Anna was saying, they recognize stock markets are fully valuated and need to put their money into rock solid investments where they're going to get a positive absolute return. That's this private equity market. All right. So why are we only hearing about this now? Because again, taking the survey of 100 people, typically maybe 1 or 2 people know about private equity investing. So the 98% are kept in the dark only because that in Ontario, this sector called alternative investments was only, you're allowed to invest into it as individuals since January 2016, unless you had over $1 million in liquid cash. So not too many people have liquid cash of $1 million, and therefore not many of us were investing into the private equity space. And that's why most of us were invested into mutual funds and the banks, right? Now, since 2016, the government's recognizing the fact that it is not a really great place to keep all of your investments or all of your savings, and you should use more of a robust investment strategy that puts some money into the private side and some money into the public side. And that's what this is all about. So, what do we do? Pinnacle is like Keller Williams. We're like a broker, and we have people coming to us that want to raise funds, right? And so instead of those people just going out to the general public, they come to a brokerage like us. We vet that company and make sure that it passes all our stringent checks and balances. As long as, and as well, they also, the company has to be checked out by Ontario Securities Commission to make sure they pass all those rigorous checks and balances. So it's like a double security precaution to make sure that, in other words, the people are who they say they are, they have a past positive history, they have a good business solid plan, and they've been successful with other investments like this before. So one of the things that Pinnacle does is the due diligence, not only in the business sense, the legals, also in the financials. That is 3 separate committees that are made up in Pinnacle that do the due diligence. And here's some of the questions that the due diligence speaks to. So it's a super deep dive. The reason we do this is because we don't want to have any failures that we are supporting and we're raising funds for. And on the other side of Pinnacle are the agents, and that's what I do. And we get out and help people understand that these investments are out there. And so there's 140 of these agents right across Canada, and we're raising currently around $300 million a year for the private equity sector. So even the TD Bank has recognized this private equity, and they call it the alternative, the new standard, alternative investments, and they wrote up a big article about what alternatives are all about. And what I loved out of that was this first saying that if you have a portfolio without private equity investments in there, it's like driving a car without an airbag. So back 50 years ago when cars didn't have airbags, you didn't need them anyways, right? But nowadays, with technology and science the way it is, it just doesn't make sense to get into a car without airbags. And as TD puts it, it doesn't make sense to have a solid portfolio without alternative investments in it. So I brought Anna along with me because that's one of the companies that Anna works for that is on our shelf. And she's going to present to you everything you need to know about a self-storage investment that is one of our hottest investments right now. And I know it'll make a lot of sense to you because you're in real estate and it's a real estate play. But we have different types of investments too that are away from real estate. If your own portfolio, your client's portfolio is heavy invested into real estate, we have other types of investments that would balance that real estate portfolio out. So bottom line, and I think Anna, you're going to say this, is that when you or one of your clients have an opportunity to invest here, It then comes to, we have a one-on-one to find out what your particular needs are and what what your big picture investment is. And then we start looking for different types of investments that fit your personal portfolio perfectly. All right. So, but without any further ado, let me introduce Anna up here, and you can start.
Talk about Nationwide
Talk
first?
about Nationwide,
Okay.
absolutely.
Well, thank you all for attending our luncheon. I'm going to talk about two investments, one of which, as Steve alluded to, is a hard asset play. I would assume everybody here understands hard assets and the value of owning real estate. And also another one is a tax-efficient strategy that will help to mitigate your taxable liability this year. So if you have a looming tax bill with CRA, that investment will help you to mitigate or eliminate the tax. So with respect to Nationwide, who we are, now Steve alluded to the fact that Pinnacle does a rigorous due diligence process to approve any product that's on their shelf for their agents to sell. And we can attest to the rigorous due diligence process because it takes them roughly 3 months to approve any product on the shelf. And what they do is not only ask a whole litany of questions, but they actually go and visit the site locations. They talk to the management team. They look at past track record of the management team before they approve it to their agents. And then their agents act as a fiduciary to you as a client in selling the products that have been vetted on their shelf. So what Nationwide is, a couple of things I want to point out before we get into the presentation is it's an equity play. There's no leverage. So this is a no leverage pre-construction real estate play based in Vancouver. And it's actually at the border of Vancouver and Burnaby. So you see where this McDonald's is? This is Vancouver. And across the street where the Audi dealership is, that's Burnaby. Now what's important about that location is it's a great location. It has a lot of traffic count. But what's really important is that Burnaby has a moratorium on self-storage. And we're going to talk about a development that's going to be propping up. They're multi-residential condominiums that are propping up all around Burnaby. Tons of people with no storage. So that should really be lucrative for our investors. So keep in mind, this investment is, again, no leverage. I want to emphasize that. It's a pure equity play. It's a passive play for anyone that's investing in it. What I mean by that is you'll be buying trust units. So you, as a collective group owning trust units, you own 2 operating businesses. One is the self-storage, and just on the main floor is a car wash. So they're 2 operating businesses, cash flow rich, as Steve mentioned, consistent cash flow throughout, plus the play on land. Now, what we discovered in our first project, Nationwide 1, whereby we raised $13 million, we received an assessment from Canadian Self-Storage to tell us once it's up and running, we're almost finished construction, we're on the 4th floor, it's valued at double what the initial investment is once it's up and running. Just land value alone, not including cash flow. So this is a phenomenal opportunity to get in, especially for real estate agents, diversify outside of Ontario, get into the Vancouver market, in commercial real estate, with 2 operating businesses that will be cash flow positive, generating tons of cash. That's tax efficient cash, because it's return of capital. Okay, Steve, do you want to maybe move on? Who we are, our company's called Cato Bancorp. We have been syndicating through the IROC channel. I don't know if that means anything to anybody here, but it's primarily with the major banks. We syndicate with Bank of Nova Scotia, Bank of Montreal, BMO, National. The only 2 banks we don't syndicate would be TD and Royal Bank. But whenever we put out an issue, an offering such as this is our flow-through offering, it's always syndicated with the major banks. Why I mention that is the banks have a grueling due diligence process before they recommend any issuer on their shelf. So we've been around since 2006, so we do have a long track record. And it says here we've produced 25 nationally distributed prospectuses, energy-based mutual funds, income-based investments. We move on to the next one. This is our first project. And you'll recall what I mentioned is the valuation. Canadian Self-Storage Valuation Services provide a valuation on your property on an annualized basis. But what they're essentially saying is we raised 16.5 million. They're saying once we're up and running, which should be Q1 of next year, they anticipate the value will be double. Just the property alone, not including the operating business and the cash flow from the operating business.
Yes, ma'am.
Next slide. And this is some pictures of the site. Right now we're on the 4th, 5th floor. We should be fully up and running by Q1 of 2019. Right, we're starting to advertise for self-storage in the Vancouver market. The other thing that's good about self-storage, and I don't know how many of you are familiar about that, is that we can increase rates whenever we want. There's no cap or restriction on increasing rates. Much like when you own a condo, there's a cap on what you can charge for rent, monthly rent. So this is Nationwide 3. This was our project in Kamloops. I don't know how many people are familiar with Kamloops, but we raised the majority of the money during the summer season. Have any of you invested in the Kamloops project? Okay, so that project we're very excited on because of the land that we secured. The land, what we do is we go out and we buy land. The two objectives that, in order to be successful in two operating businesses like car wash and self-storage, is access and visibility. This is right off the Trans-Canada Highway. So anyone entering into Kamloops has to drive right by our location to get into Kamloops, and has to drive right by our location to get out of Kamloops. So the traffic count is phenomenal. The cash flow we anticipate being just as phenomenal for our investors, in that we anticipate an 8% yield, but it'll be greater than that. So investors do share into the income stream as well as the profitability. So anything over and above the income stream, our investors will participate 70% in excess of that cash flow. And then also there's capital appreciation on exit, which is a 70% payout to the investors. So say we double our money, investors will get 70% of that capital back in terms of capital appreciation. The other 30% goes to the issuer for managing the property and the expenses involved with that. This is Boundary Road. We're on our second tranche of raising money. The first tranche that was priced at 100, we raised $4 million. It sold out in less than 2 weeks. We're now at our second tranche, which is at 105. We'll be fully subscribed. We're looking to raise $6 million. We'll be fully subscribed by December the 14th. So I apologize for this because there's a tight timeline. If you do have an interest in getting into this investment, please call up Steve. It's literally almost 2 weeks away before we're fully subscribed on that at the $6 million tranche. So what's important to note here, again, I'm going to reiterate stuff that I said from the very beginning. What you're looking at in terms of this investment and why you'd want to consider it is diversification in your portfolio, your real estate holdings. It'll be based in Vancouver and bordering Burnaby. But also, you're getting two operating businesses. So this is a commercial property play with two operating businesses, storage and car wash. And we'll get into the economics of the car wash and the storage. We provide what's called a feasibility study. So for those of you that are serious, have an interest in this investment, speak to Steve. He can go through the numbers with you on the feasibility study. And what we've done is the people that we've retained to provide the independent feasibility study have essentially given us really lowball estimates on what we can anticipate in terms of a rate of return. In a nutshell, what we're expecting, this is just a conservative estimate, this is a 5-year hold, so it's important to know that you cannot sell it within the 5 years, and we're expecting a double in the investment. Probably more than a double. So this is, and it shows you here that we're sold out at the 100 price. Now we're at the 105. So we've got roughly 2 million remaining of the 6 million that we're raising. So we'll close that off on December the 14th. If any of you have interest in purchasing the investment, please let Steve know so we can reserve allocation. And we're saying here with redemptions, what we're looking at doing with respect to redemptions, that means if you want to cash out, Once the building is built, so that's 3 years down the road, we're looking at the building being built and cash flowing. At that point, we'll communicate to the investors if they want to cash out at fair market value. We will cash you out at fair market value by a debt raise financing at that point to cash out investors that want to cash out in 3 years' time. And the reason why the general partners will buy you out is because we know this is going to be a substantive, lucrative investment long term. Storage is a boring business. How many people actually use self-storage here? Anyone? Okay, it is a boring business, and I'm assuming everybody has used a car wash. You know, but
Once or twice.
yeah. So self-storage is a boring business. What makes it very intriguing in the Vancouver market is there are only a select sliver of land whereby it is zoned for light industrial to build self-storage. The rest of it is being densified, where they're building condominiums, multi-residential condominiums upon condominiums, like Toronto, downtown Toronto, but Vancouver is more magnified. The average square footage in a condominium in Vancouver is about 450 square feet to 550 square feet, and you're getting zero storage. So this is called lifestyle storage. It is designed for the condominium individual that needs to store their winter wardrobe somewhere, or their summer wardrobe somewhere, or their recreational stuff. So the objective in this is twofold. This investment will provide you monthly income once the building is built and we receive cash flow from the self-storage as well as the car wash. So you will get paid, the yield is 7% now at the 105?
So 7.4.
7.05.
Yeah.
So the yield is 7.05 at the $105 level. And as I mentioned, that yield is tax efficient. So it's return to capital. But anything over and above that 7% yield, because this is what we owe you today, even though the building isn't built, it's what we call a catch-up or preferred yield. What that means is if you purchase today, it'll take 2 years to build a facility and cash flowing. We owe you 14% catch-up to make you whole, and then we continue with the 7% yield. So it will accrue for you until such point in time that the building's built and cash flowing. Anything over and above that 7% is paid out 70% to the investor, over and above the 7% cash flow, 30% to the general partner. I think I touched on that. Yeah, touched on everything there. So this is what, any of you familiar with this location? Okay,
I
so
used to live in Vancouver, I know this location.
there you go, so you know it's a
There are
great location.
condos popping up on the
Everywhere.
Burnaby side. It's
Yeah,
fantastic. It's like a fishbowl
yeah.
coming down Boundary Road.
That's why we're so excited about it.
That's
Because
why
it
I'm
is
so
there-
excited about
like
it.
there's traffic all over the place. That's the highway, the Lockheed Highway. These are highly trafficked. Approximately 38,000 cars go by that location daily. So, and it's traffic and it's log jam, so they're gonna see our location. And we're conveniently located right next to everyone's all-time favorite, McDonald's. I don't eat at McDonald's, but people like McDonald's, right? So, and there's an Audi dealership as well. So anyway, it's conveniently located. We have, as I mentioned, feasibility studies that mention, assuming we do 500 cars per day. I said 38,000 cars go by that location. So that's, a little over 1%. That should generate positive cash flow to the point where it pays for the cost of the car wash, then some. So you're looking at positive cash flow about 20% a year, just at 500 cars per day. The car wash that we've built, see it says 38,000 cars, but the car wash that we're building is not only environmentally friendly, because we're recycling the water, and also the building is net zero, so it'll be the first building in Vancouver that's net zero. So it's environmentally friendly as well. But that car wash, as well as the self-storage, will be well lit, people will see it, I don't know if you can see the sign, but people will be able to see it from the highway and see it while they're driving by. So you'll recall what I mentioned, the two factors that provide you with success in the business are access and visibility. So it'll be there, front row center, very visible. We actually received an offer from the owner of the McDonald's for $3 million more than what we paid for it, the property alone.
Nice.
So this is the population growth. Now, you'll see that that big yellow indicator right there that points to, that's a huge development site that's going up that should be built by 2020, they're looking at the completion of that build. It's called Brentwood. But there's 28 acres. They're all multi-residential high-rise condominiums, average square feet 450 to 550. So the population is going to be there in order for us to garner all that cash flow. They won't have storage, so they'll be looking for self-storage facilities. And Burnaby, you'll recall I mentioned, has a moratorium on self-storage. So we are conveniently located right on the border of both Vancouver and Burnaby. So this is what, that's a picture of the facility. It's going to be very high tech, the facility alone. 90,000 square feet of net rentable storage space with sky lockers. Anybody know what a sky locker is? Because I didn't know until we got into this, which is new to me. It's not your traditional lockers. We're going to have stackable lockers per floor that are essentially 5 by 5. So about my height and width. And that's to do with lifestyle storage. That's to facilitate condominium owners. So on the main floor, you'll have your average, I don't know if you can see it. You can see it probably in the picture. If you look at this picture here, if you look closely through that plate glass, you'll see that there's an average size storage facility, and just above it is a little tiny storage that's 5 by 5. And that's the latest trend in Vancouver. The company that will be managing our storage is called Access Results Management. They're Storage Vault. I don't know if anybody's heard of Storage Vault, but they're the largest self-storage owners in Canada, much like Public Storage in the US. And they have told us that the lifestyle storage, they can't keep enough in play because they're over-rented, if you will. So that will accommodate the influx, if you remember, that we showed on the multi-residential new condominiums that are going to be propping up around our vicinity. Anyone want to know how you get up there? To get the,
I was going to ask that question.
that was my question,
Yeah.
because you're going to have a big box and you're going to have to go up there and kind of throw the box in that self-storage. They've got these big ladders. Have anybody been in a mausoleum? The best way to know it, to explain it. If you're in a mausoleum, they have those ladders as
They
well.
have that ladders at Home
Yeah.
Depot as well.
Do
You know,
they?
the see
Okay,
the
so-
orange ladders.
Yeah, they're
Guys go
heavy
walking up.
duty ladders where
Right.
you just go
Oh,
up
okay.
and then you
Mausoleum.
can access them. Well, they do have them in
What?
mausoleums.
Use the
So-
Home Depot as a bit of
Okay.
reference.
Okay.
Yeah.
Oh, there you go. Death is one of the reasons why people use storage.
Right.
So the 60s, why do people use storage? And mostly people use storage for divorce or when you're downsizing. And death as well. You know, if you have an aunt or a grandmother that passed away and there's furniture that has sentimental value, you want to store it instead of giving it away. And for disasters, like dislocation, but primarily in our case for densification. Because this is what Vancouver's moving towards, is densification. Very little land, but everything's going up, and lots of condominiums that should help to increase our cash flow and our self-storage. Oh, this is what it looks like.
Yeah.
So yeah, you use a ladder to get up there. Yes?
So are we investing in one of the projects, all the projects?
This current project
Current
is the
projects,
one
the
that's
one in
available for purchase.
Burnaby and
Yeah, the one that's in
The other two are
Vancouver.
fully
And that's-
subscribed.
it's 7% yield?
7% yield.
That's
Which
the
is that
preferred
for?
yield.
Yeah.
Which
so,
means that's the first profit that's out pays the investor 7%, and then we're anticipating to have a lot more cash flow.
And that gets paid out yearly as
No.
a special?
monthly.
No,
Month.
7% monthly. Well, the yield gets paid out monthly,
Correct.
but if things go well and there's a lot of
Monthly.
cash,
Yeah.
All monthly. All monthly. So as we collect the cash,
Yeah.
we distribute out the cash. And we will let investors know, because we're used to doing this, we do cash flow investments. We send out a monthly update to investors to say, listen, it's generated X number, we paid you your 7% preferred. This is the excess that we're paying because we've received more cash flow. At 85% occupancy, you're gonna get a better yield than 7%. And we anticipate being fully occupied at 85% in less than 6 months when this is built. Access Results Management has told us they expect that we'll be fully occupied in a month's time because the demand is so great in Vancouver.
And our team's saying that at 95%, so not fully occupied, that cash flow, just the cash flow element, should be somewhere between 15 and 20% per year, paid out monthly. So you put 100 grand in, you're gonna get 20 grand just back, return of capital, which is no tax implication on that whatsoever, paid out to you monthly.
So how many lockers are there? How many storage?
It's in the book.
Yeah, it's in the book, and I keep on forgetting because we've got 3 projects on the go. It's in here, I can't remember, and I don't want to give you the wrong amount. But we have it in here. And the other thing too is that Steve has our feasibility study, which goes through, you know, assume that we're only 45% occupied, which is really lowballing our occupancy rate. How much? Yeah, okay, there we go. 1250. I should know that number, but I don't.
Is there a breakout in that about what
Yeah,
the
there
lockers
is.
look like
This
now?
is 1250,
Yeah.
including skylockers.
Okay, because my feasibility study has the breakout. It shows you how many are 5 by 5, how many are 5 by 10, 10 by 10, whatever. So there's different size of lockers that we have.
And how much is the average rate? What's the fee for them?
Yeah, I know it's something crazy, like the Skylockers go for like 180 or something like
Yeah.
that.
The 5 by 5 goes for 180 a month.
Yeah, there you go.
A 10 by 10 locker is 360 a
Is
month.
that
People pay
crazy
for that.
or?
And a 10 by 20 is 550.
And they go up every year too
Per
in
month.
Vancouver.
Per
They're
month.
going up every year, yeah, per month. Well, keep in mind, they've got lifestyle, right? Lifestyle storage. That's what's critical, because most people have very little living
Makes
space.
me giddy.
Yeah.
So they have to store their
Unless
stuff
you're
somewhere.
renting.
Like if you're living in a 550 square foot condominium
I'm in
and
all
you've got
three
no
of those.
storage, where do you put your
I'm
stuff?
in all three of
I'll
them
leave it.
since the beginning.
And people get so attached to their stuff.
Everyone
They
in
feel
Yeah.
like they can't, like, who cares about your aunt's furniture? It's not going to change your life if you get rid of it.
Right.
But they forget that they have that stuff in the storage locker because it then just keeps.
Yeah, they just pay monthly.
Yeah. That happened to me, like between moves, like I was renovating and everything, it was just easier to store it. And then 2 years later,
Yeah,
I donated everything, and like,
wow,
I would not have paid
I've done the
a
same thing.
tenth.
yeah.
Yeah. I've done the same thing. You just store it and forget about it.
Yeah.
But the nice thing too about with self-storage, you could be double occupied. Because what happens is people will leave mid-month and then you get another person coming in mid-month. So you're collecting rent from 2 people in 1 month.
Yeah. Is there a minimum investment amount?
$10,000.
And it is RSP, tax-free savings eligible as well as cash. Next.
Yeah, this is the car wash. Our car wash is technologically advanced. The people that manufacture this particular car wash, it's called Sunny's. They're in Tamarack, Florida. There's only 5 car washes, high-speed car washes like the one that we're building in Canada right now, 3 of which are in Vancouver. There's one just off Terminal. They do 1,500 cars per day. And we're anticipating we're probably going to do somewhere around that vicinity. But this does, see how we say 90 cars per hour? So this is the car wash. In the car wash tunnel, we could do 8 cars in the tunnel.
At once.
At once. And it's from beginning to end in less than 5 minutes. And you're bone dry by the time you leave the car wash. So it's all automated. We will have, I don't know if you've used, there are automated car washes right now that you can use, but we will have 1 person manning it. So if we do 500 car washes per day, this will generate, in terms of a rate of return for you, a double. But we anticipate And again, that's a lowball estimate. We anticipate we're probably going to do something similar to the one on Terminal, which is right in Vancouver, because of the densification issue and 38,000 cars driving by this vicinity every day. We think we'll do 800 cars per day, if not more. And if we do hit 800 cars per day, again, Steve can get into the feasibility study with you. The numbers are absolutely, I'm going to say stupid, just staggering how much money you're going to generate from that car wash alone. Yeah. Now this shows you, you'll recall I mentioned it's environmentally friendly. This is very important in Vancouver. So everything is recycled, reclaimed water tank. We move it, every day we take away the water that's polluted and recycle it with fresh water. And the water that's fresh, because it will filter that water, will go back into generating the water to wash the cars. Now the reason why we show this, much like Steve, this is our layer of due diligence for our investors. We are a reporting issuer. That might not mean anything to anyone, but we report all our financial statements and all the products that we issue and offer to investors through CDAR. That's an electronic government site where you can go in, key the company name, key in the investment, and you'll see all the financial statements. Full disclosure. We partner with, and our accountants are KPMG, our lawyers are BLG. We partner with Scotia for financing. Storage Vault, I mentioned, they will be managing our storage facility. Why that's important to our investors is they're the largest self-storage company in Canada. They know what they're doing. They know how to attract people to the site. They've told us that once our projects are built, like our first one, they anticipate 100% occupancy in a month's time. So we're going to find out pretty soon in Q1 of 2019. But there's so much pent-up demand in Vancouver, unlike Toronto, that there's not enough storage facilities to facilitate the densification of the high-rise condominiums. And this is our, yes?
I'm not sure if you already mentioned it. Is there a minimum amount we need to invest?
10,000.
10,000.
10,000, and as Steve mentioned, it's eligible for your RSP as well as your tax-free savings account. So, these are our general partners. The principals are Hugh Cartwright, Shane Doyle, and they've been in the business in excess of 20 years. Brian Sturloff, over 30 years. Nancy, over 25 years. John is our accountant, over 15 years. So again, full disclosure for reporting issuers. People in the bank channel will know of our company. We're known on the street. Who is Storage Vault? I touched on this. They do trade on the stock exchange for any of you that like buying stocks on the stock exchange. They have a nominal yield. The company yields about 1.2 annually. The reason for that is they're aggressive acquirers of self-storage across Canada. They've actually purchased all the self-storage in Kamloops, with the exception of our site. And they love our site. They've already said to us, once it's up and running, we'll buy it from you for double what you paid. So we've got them already interested in buying us out. And we like to mention the risk factors. So what are the risk factors with this investment? As Shane would sarcastically say, there's a seismic risk. Because most people talk about Vancouver and possible earthquakes.
Is that written somewhere?
No, it's not there, but he'll always mention that. And I don't know why he mentions that, but because we're not on the fault line. But if we get a mild earthquake in Vancouver, it's really good for us, right? Because things get destroyed, then they have to, they're renovating, they got to store it somewhere. You got to store your stuff. So there's competition, that's a factor. Geographic concentration, not so much. Low cap rates. If we head for a recessionary period, and I don't know, our business cycle, maybe we head for a recessionary period or not, but what we do know is storage is kind of recession proof because people will store their stuff in good and bad times. And considering the high divorce rate in Canada, people tend to store their stuff. And so the reason why I laugh is because I went through that myself. So I stored my stuff for 3 years. Anyway, that's it. And feel free free to visit our website. We have 2 websites. So again, full disclosure, full visibility. You can find out anything you want about us. Just visit nationwideselfstorage.ca. This is our website. Again, I urge you to talk to Steve because the feasibility studies are very compelling. Steve can go through the numbers with you. It's quite impressive. When you go through the numbers, you'll want to invest in this offering. So if you're interested in buying at the $105 price, we have 2 million, actually less than 2 million remaining. Your deadline is December the 14th.
So any other questions about this? So remember, Pinnacle has about 21 other companies like Nationwide on our shelf that we can choose from for any of your particular needs or wants. Now there's a second one that Anna's got.
That's our flow through.
And there's a really, really, really quick presentation and a really in-depth, long, crazy presentation. So I think we'll do
I'll
the
do
real
a quick one
quickie.
because I think everyone is probably anxious to get out.
But I do want to stress that this one is for high net worth people. Anybody earning, you said 300, eh?
Anyone earning, okay.
So I usually
This flow through, and it's called a flow through, Maple Leaf short duration flow through, has been around since 2006. So we've gone through the ebbs and flows of the commodities market. So it is tied to the stock market. But it's applicable for anyone that's earning in excess of $160,000 a year. And you know you have a looming tax bill with CRA. I would assume everybody here probably knows if they're going to have to pay more tax to CRA when they file their income tax return come April of 2019. Well, here's a strategy.
Do you want me to put that up?
Yeah, here's a strategy to help mitigate and possibly eliminate your taxable liability. I've been buying this for over 20 years. I've never had to pay additional taxes. I mean, you pay as you go, but I've always managed to get a refund as a result of the flow through. So we're looking to raise $10 million in flow through. The deadline for this, and again, I apologize because the deadlines are very tight. It's December the 10th. So if any of you know that, what you earn this year, you probably have a pretty good, I don't know if you're paying by installments or however you're paying, but you probably have a good idea come April how much you're going to have to pay to CRA. So you can kind of play with that. Let's say you have a $10,000 liability in flow through. I'm just going to skip and give you the shorter version and then go into details. But let's say you owe $10,000 to CRA. And I don't know anyone's tax situation. You've got to consult it with your accountant. But just as a broad brush, this is how it works. If you owe $10,000 to CRA, it's a binary decision for you. You either pay CRA the $10,000 that you owe and get no rate of return on that, or you invest in something like the flow-through and possibly eliminate or reduce the taxes you owe, and then get some sort of rate of return on that when it becomes liquid. It's a 1-year hold. So next year at this time, you will get your money back. But I can't tell you what that's going to translate to because the underlying investments are commodity-based investments that are publicly traded on the stock market. Oil, gas, gold, nickel, copper, zinc, all resource-based. So the decision you have when we start with the $10,000, if you invest $20,000 in flow-through, that will eliminate the $10,000 liability, meaning you don't have to pay CRA $10,000 and you'll have a $20,000 investment in flow-through. But the tax savings you get up front on that $20,000 is at a 53%, let's say 50% marginal tax rate. Your marginal tax rate is important in this analysis. So say you're at a 50% marginal tax rate, you invest $20,000, you got a $10,000 tax bill with CRA. That $20,000 will reduce your taxable income dollar for dollar at your tax rate. So $20,000 at 50% marginal tax rate means you get $10,000 of savings, thereby eliminating the $10,000 you owe to CRA. Hopefully that makes sense. I'll go through a table. We've got a table too. So I'm just giving you the high level of how it works. It's a tax strategy. Flow-through's been around since 1950. So I'm not talking about anything that's new. It might be new to people in this audience. Has anyone ever bought limited partnerships before? mitigate the taxable liability. It's been around since 1950. Next slide. Minimum purchase is $5,000. Okay, hold on. I just want to talk about our portfolio manager, if you can go back. This is our portfolio manager, Craig Porter. He hailed from Front Street in Altamira, so people know him from there, but he's been managing flow-through for over 30 years. He's very capable, very competent. You're in good hands. What are flow-through? Now, flow-throughs were created by the federal government. There's an actual line on your T1 General. I don't know if you prepare your own tax return or you get your accountant's, but it's on line 244. It says it specifically, deduction for Canadian exploration expense. That's where you're getting your 100% tax deduction, right on that line. So why did the government create flow-throughs? It was to help resource companies, unlike the federal government, like the Liberals that don't want to help oil and gas companies, but it's to help oil and gas companies further explore for oil and natural gas, including renewables, including nickel, copper, zinc. We're a resource-based country. This is why that exists, is to help oil and gas companies continue to explore for the hydrocarbons that we need. So how the flow-through works and how it relates to us as investors, our portfolio manager, Craig Porter, this is what we do, I'll give you the chronology of it. We raise money. We just closed off our prospectus offering that was syndicated by the banks, where we raised $10 million nationally. Now that gets sold within 2 months. So that sells out quickly. Advisors know about the product. Their clients are conditioned to look for it for the end of the year, because they know the benefits that flow-through provides in mitigating their taxable liability. So how that works is our portfolio manager will take all the money that we raise and then call up junior oil and gas mining companies and see if they will renounce their Canadian exploration deduction, which is 100%, to our LP investors. They do that through their treasury shares, so it's not through the open market. They will call directly companies like Tourmaline, like Whitecap. I don't know if you're familiar with these companies, but they're resource-based companies. So he'll go directly to these companies. They have to trade on the stock exchange because we provide 1-year liquidity. We have to be liquid. They will say, okay, I've got X number of our shares, good to go. We'll renounce our Canadian exploration expense. That's the 100% tax savings that our investors get to the flow-through investors. So it flows through to us, and then we divvy up the tax deduction to our unit holders through what's called a T5013. That's the tax slip you're going to get. And you'll get that at the end of March. Now it's extremely important when you get that tax deduction, if you've got your accountants preparing your tax return, please don't forget to give them that, because that gives you the 100% tax deduction. And the reason why I say that is people forget. Don't forget, because that's the reason why you bought the flow through in the first place, to get that 100% tax deduction. Okay, so I got into what an investor is buying, and that's you're buying a basket of junior mining exploration stocks that are all publicly traded on the stock market. Now this is what we call our term sheet. Right, you see that pretty little pie? That shows you how notionally we will diversify the portfolio. Again, what's key to note with the securities that we buy, they're companies that will be renouncing their Canadian exploration expense, the 100% tax savings, which you will get that flows through to the limited partnerships. And and we do not concentrate on one particular company, so it will be diversified, further mitigating your risk. Now this is what I talked about initially. This is the line for Ontario. So anyone that earns $300,000 a year or greater, that's your tax rate. You're paying more to our government than you're keeping in your pocket. This is why people buy flow-through. Essentially for that. It's to mitigate and reduce your taxable liability. So I did mention the $10,000. So at the marginal tax rate of 53.5, that's your tax savings. So net out of pocket to you, your at-risk capital is $4,650. And the reason why that's important is your overall rate of return does include the tax savings you get up front. Next slide. That's Quebec. They get 141% write-off. So you'll recall I said this is a one-year hold. So if you buy today through Steve, we will, as I mentioned, our portfolio manager will be investing all the collective money to flow through the 100% tax savings that you will get. Come March of 2019, you're going to see mailed to you a T5013, that's your tax slip. In April, you take it to your accountant fills out your tax return, and hopefully as a result of buying flow through, you net out at zero, or you reduce your taxable liability. One of two things will happen. You are guaranteed to get that 100% write-off at your tax rate. There's no question of you not receiving that. So that's the chronology of what will happen. If you buy today, the fund will close December 10th, which means you have a limited time to make your decision. It should be contingent upon how much you owe for flow through and what your marginal tax rate is. There are two. Marginal tax rate, it's important that it has to be above around 48% or greater. And also if you know you're going to have a taxable liability. That's why you want to buy flow through. So those are the two decisions. And then the primary decision is you either pay CRA or you buy flow through to mitigate your taxable liability. So at that time, we close on December the 10th, our manager will invest all the money that we raise. In March of 2019, you will get a tax slip, the T5013, showing your original investment. You deduct it off line 224 of the tax return, T1 General, your accountants know how to do that. And then around May, June, you don't have to pay tax, or maybe you get a refund, one or the other.
And can you imagine, this was the brief, short version.
And these are all the flow-throughs we've done. So that's it. If anyone has any questions.
Typically we present flow-throughs to accountants because they are the ones who look at their clientele and say, Bob, you made way too much money. Here, do $100,000 of this. So the reason we thought we'd tell you guys because you're still dealing with a lot of high net worth people as well, or maybe a few of you made a lot of money one particular year. It's just good to know this stuff exists.
Or if you have a huge capital gains because you've sold some properties, flow-through will offset the capital gains tax.
And you mentioned you get the money back.
Yeah, in a year's time, we'll dissolve the flow-through, whatever it's worth, because it's invested in junior stocks. So in November, end of November, first week of December, you'll get your money back. And you can recycle and do it again at whatever the NAV might be. Now the net asset value for this offering, issue price is always $25. And that's important. I don't know if we have a slide on that, but you'll recall I mentioned your rate of return includes a tax savings. So your break even, if you're at a 53.5 marginal tax rate, on 25 your break even is $14.85. Now optically that looks like you've lost a shitload of money, but you haven't, because it factors in your tax savings. So the tax savings is part of your overall return. Your break even is $14.85 on 25.
So I'll just sum it up this way. If you feel that you know somebody or yourself can facilitate something like this, then we should have a chat as well. There's a little bit of information that definitely we include your accountant with this calculation because they're the ones that are doing all that. So it's a couple of step process. But I think it's really excellent to know that this does exist. And this is how the rich keep getting richer. Yeah, and now that we're in on the gig, hopefully we can keep more money in our pockets and continue to grow.
So hold on, the one thing I wanted to mention, it's also good for anyone that does charitable giving. Anyone do charitable giving in the room? Yeah, works perfectly. And the reason why I mentioned that is instead of paying with after-tax dollars, you're paying with before-tax dollars, because when you get the flow-through, it becomes liquid. You can donate the mutual fund units to your charity of choice and get another tax deduction on that dollar.
So why do they even do this though? Like, why is it a tax write-off?
Because the government needs to support the mining industry.
Okay.
The government's not going to take money out of their own pockets.
Right.
So they say, tell you what, Mr. General Population, if you invest your money that you were going to give to me anyway, we'll give you a tax credit for that.
Do you know how badly our companies need that money? Like, I don't know if anybody's aware of what's going on with Western Canadian Select. That's a spot price for our oil compared to WTI in the US. WTI right now is trading at $56. Our oil is trading at $16. The Liberal government has pretty much crushed the oil and gas industry. If you're living in Alberta, you're going through a recession. It's critical that these companies continue, they constantly need cash to continue to develop the hydrocarbons. And we sell our hydrocarbons to the US at $16 a barrel, and then we buy it back from them at $56 a barrel.
Are there any initiatives to go green with that though, like invest
Tons,
money
yeah, there's
in solar?
renewable, there's renewable
Like
as well.
within this?
There is renewables as well, yeah.
Okay.
But it's, these companies desperately need capital to continue to explore for our hydrocarbons.
Business card?
And again, thank you very much for coming out and enjoying yourselves.
Yeah, thank you all.
Specifically, you said the